Yeah,
Got that
promote
over
whatever you want to. Okay.
Yeah. Yeah. Sure. Thanks.
Hi, everybody. We have an excellent interview for you to kind of compare to what's happening in the markets where everything seems to be going up. You could talk about any asset class. You could talk about equities. You could talk about crypto. You could talk about commodities, everything. It's a belong the world type of market. And we have a analyst slash trader with us today, Henrik Zeberg. Welcome to TradeGate Hub, Henrik. I've followed Henrik for several years now, and he's a guy with conviction and also quite a contrarian view in the light that everyone has embraced the inflation, whether it's transient or not. I think that we're underway for the inflation cycle, and Henrik does believe that there's one more shoe to drop. So why don't we get into your presentation here, Henrik? Welcome to TradeGate Hub.
Thank you very much, Dale. Thank you for having me. And thank you for introducing me in that way. It's definitely true that something that we have been waiting for, and I've been promoting for quite some time. So I'm not ashamed to say that. But still, it's something that we think it's going to happen, and I think it's going to happen. But still, I had to put this on because you have been on here a few times actually, and you have actually watched me grow older in real time while I'm waiting for the deflationary button.
Yeah, but you really look good, even though it's taken an extra couple of years. Yeah, I mean the Fed has surprised everybody, hasn't it? That how long the markets can believe the baloney.
Exactly.
All right. Exactly. So thank you for exaggerating how you've aged, but we have your picture here. And I before we get into this, Henrik, and you're talking about how you've had to wait, and at times the markets have moved contrary to this final washout and capitulation, liquidity type of problem where people will sell everything, including the kitchen sink, to raise cash. How are you able to not lose conviction about this scenario when things always seem to be, for me, I'm always early. Why, how do you keep your conviction when things take longer than you expect for them to happen?
Well, first of all, I think we had some piece of evidence of what's going to happen when it unfolds last year. I mean, it's a long time ago already when we had February and March, and we saw the kind of decline, we saw the kind of panic, outright panic that we saw in February and March. And I know everybody forgot about that already. And March.
It was 6 weeks. I counted the weekly candles, right? 6 weeks, we lost 30%, right?
Exactly. And that's the kind of event we're talking about here. And then everybody says, well, the Fed has got it all solved, and this time around they will not make the mistake. But I just see it in another kind of manner. I see this as, it's a house of cards. It is cards. It's a sandcastle, and really that structures will eventually bring it down. It's not about we can build it a little higher, but at some point the structure is so unsound that it's going to come crashing down. And I know that as you also mentioned in your intro, that the popular opinion is that it's going to unfold in a way, in an inflationary kind of way. I just think that's wrong, and that's where I when I look at the graph, the charts, and the for commodities especially, I see that it seems like another decline, or strong decline actually, before we get to that inflationary point. And especially when we look to gold miners, which is one thing that I care really about, because that's where I see, among other miners also, that you're going to see a fantastic opportunity to get long at some point. So my conviction, my focus on this remains in the way that I've seen it. I see it in the structures, and that's kind of what I want to run through first.
Okay.
But I want to emphasize that getting to that part when we see that final bust, well, that's also the point where we're going to see a shift in what I call economic regime, kind of what we saw back in 1982, where we went from a inflationary regime into a more deflationary regime. It wasn't felt like deflation, but it was where interest rates started to decline from 1982 and onwards, from the Volcker moment. So that's what I see.
Okay. All right. Let's go through the presentation. And I know you're looking at different markets, different asset classes. Before we start, you say here the Fed has managed to keep markets up longer than I expected. So is it going to be rates that are going to be the pin that pops a bubble?
It's actually a fantastic question there, sorry, Abel, because I think that's what we put here. And if you put Ludwig von Mises on, and really that when he says, there's no avoiding of a final collapse of a boom brought about by credit expansion, the only alternative is only whether the crisis should come sooner as the result of a voluntary abandonment or further credit expansion, or later as a final and total catastrophe of the currency system involved. And what we see here is that, we are at a moment, we are at a point in time where we see inflation moving up. And we see that the Fed, even though Powell came out a little dovish, at least what he spoke, but we saw that the Fed members behind were a little more hawkish, or actually much more hawkish. And I don't think that the market is ready for any sort of, financial tightening at this point. I mean, even just the talk of it could bring things down. So that's back to the forecast.
Yeah, what's interesting, Henrik. I said I wasn't going to interrupt you. I broke my promise already. Is that a lot of people think that a taper is a tightening, and I guess it could be, but it's not actually tightening. It's reducing QE.
Sure.
So, if the market is afraid of just reducing the money flow that's going into QE, tightening is a completely different matter. So a taper is less liquidity. I don't know if you could call it a tightening, can you?
Well, it's, you can also see the tightening from the move up in rates that we have in the markets. We have to remember it's actually not the Fed that runs the market. It's it's actually the market that is running it, the rates. And and the rates have been moving up, and we have seen the spike that we also foresaw at the Zeberg report, and that is by itself a tightening. So it can go on for some time, and it will force the hands also of Fed at some point.
Okay, so you're talking about the move we had from 30 bips, 50 bips to 170 in the 10-year, and we backed off to about 113. So, perhaps we're ready for the third wave or another advance in rates that could take the 10-year back above 2%, 210 or so.
Yeah, but let's look at it like this. If inflation is going up, at some point rates are going to come up. And then we have to look at ourselves and think, do we really think that the valuations, which are at perfection right now, will bear that the rates move up? Or do we think that the parabolic move up is going to go down in a parabolic way as well? That's what we normally see. When we see that when the financial condition starts to tighten, we will see that the valuations come back crashing down. And that is what I expect also to happen this time around. As I said, it has been going on for longer than I expected. We've seen the boom, the sugar high that we got from the Fed when, what they did last year into the Corona crisis. And then we have the situation now where we have, absolutely unbearable high valuation levels. So I think it's going to be it'll be a point in time where financial conditions based on whether it's going to be the market or it's going to be the Fed members bringing valuations down.
Okay. All right. So I'm ready to see what you prepared.
Yeah, sure. Let's take a look at. So this is really just to go through the kind of the thinking here. So we got a boom here brought about by the credit expenses that we talked about. We had the Fed's balance sheet has been ballooning up, and we have the S&P, which the valuation of it has been following that. And when we looked at Ludwig von Mises, he said, well, at some point, a credit expansion like that is going to come crashing down. It's only a matter of when. We know the Fed is all in. We know the money velocity is crashing down while the Fed has been trying to push markets up. The fact that the problem is only that the real economy is not following it in on this. It's being kept in check by the fact that we have, I think it's too much debt in the world. The only thing that the Fed has then achieved to do is to create this, as I said, the ultimate sugar high with this steady stream of money printing. Whether as you said, a tapering, so bringing it down just a bit, is going to be enough. At some point it will be something that will be they will need to come down with the also bring down the stimulus much more than what we see now. But already now we see that the credit impulse is rolling over. So we have the Chinese credit impulse, which really leads the commodities. And what we see is that it's rolled over as severely as in 2008.
Yeah, you have China on your side now. They've really stopped buying. I've read things. They want to put a tamp down on commodities. They want to drive things down so they could buy things cheap again. Whenever they're saying that they're going to tap down, or the sellers are trying to take a market down to accumulate, and when they're positive, they're trying to distribute. I just want to point out that the Fed's balance sheet began to expand dramatically before COVID. Traders have a short memory, and they had to come in because there was a problem in the repo market where banks would not lend overnight to each other. And that's where the blue line really began to pick up before we even knew there was a pandemic.
Exactly. And that's also why I don't think the pandemic by itself, from an economic perspective, has of course been important, because it brought about a lot of credit and a lot of stimulus, but I think what we see is the economic conjunctures are actually moving by themselves, and as you said, this move in the credit impulse was going up before we saw the COVID crisis, and we are actually now seeing a plunge. So I think this is going to be quite significant for commodities, and that by that I also see why one of the main reasons why we are going to see commodities plunge. And there you also have inflation, and that's why I don't see a stagflationary event of this first. I see a deflationary, meaning that inflation will come down while the economy is also struggling, not inflation. And that's why I do not normally find myself on the same side as what I hear from the Fed, but I actually do think that the inflation, what I call a bounce or spike. Is transitory. It's going to roll over quite severely at some point, and soon, actually.
Okay.
And then what I just put here is that we really didn't see the economy follow what we saw in what we've seen in the credit cycle here, because we've seen a sugar high, something that has been pumped up really quick. But what we also seen is that in the small chart here on the left side is really that the average week of employment is moving up. So we wouldn't see that in an economy that is doing well. We would see, average number of weeks that people unemployed should move down lower. But that's not what we see, and that's why we do not have an economy that is going to bear itself, carry itself, and you do not get real inflation, real economic inflation in an environment like that, not a lasting one anyway. So. Okay. And that's why I think, and also if you look at the PMI numbers, you can see that yes, we have moved up to levels that have normally been levels where we would see a turn, or normally would be a top. So what I think that the Fed managed to do, or all the governments of the world and the central banks of the world, was to actually into something that wasn't as a severe a crisis as everybody seemed to think it was. They, put in a massive amount of stimulus and just then created this spike in inflation. And of course they would bring in an economic boom that would last for some time, but it's rolling over because the real economy is not fixed. We still have supply chains that were destroyed. And by the end of the day, it's all about debt. It's all about the debt crushing, leverage we have on the entire world. And which is bringing down the real economic cycle, of the real economic activity. So I don't think we're there where we start to see inflation coming out of this, and we are definitely not where I think in recovery and economic expansion is going to continue from here on. I think we are standing. It's feeling rather nice right now, but that's normally how it feels when we are close to the top. And
also besides the Fed, all the fiscal support that people have received, money from the government to keep them going, the moratorium on evictions, PPE programs that even, you know, businesses that were doing quite well still took advantage of it, added liquidity
Hmm.
to their balance sheet. Where are you at as far as the consumer? Everyone's saying with high house prices and stock portfolio and money they've been receiving that the consumer is healthy, their balance sheet is healthy. Do you think that it's healthy, or will they wake up to a reality that they didn't care what they spent when they could finally go out and go on vacation and go out for dinner and put it on the credit card, and that this fall they're going to realize that they're going to have to slow down their spending after the prices for airlines and hotel rooms and everything else comes home and they owe it.
Yeah, but what I can see is that the stimulus money that has been sent out to, especially Americans, haven't been used for consumption to the degree that was wanted. So they have spent, the consumers primarily spend that on bringing down debt, which is not what you want.
Yes.
So that actually shows the size of this deflationary, hole in the ground, or whatever we should kind of characterize it as. So you do not see that spending binge that you would like to come out of this has really been brought about. So that's why, of course, we're going to see the primary effects of a stimulus, like that coming out. But it's actually the secondary and the third and the fourth and so on going on that you need to have in order to get it, to get the machine running. And that we haven't seen. We haven't seen that kind of spending. It actually did get sucked into debt reduction and things like that. And of course, into the market. And then everybody will say, well, and then, yeah.
GameStop.
Yeah, exactly. Into GameStop. Yeah, exactly.
Yes.
And that's why I mean, of course, we did see the inflation expectations move up, but the inflation has moved up quite severely also with this spike. But I still see that as a part of the, we have to remember that inflation is a lagging economic indicator, meaning it's not something that is preceding an economic boom. It's something that is, following an economic boom. So things have been in demand, but they haven't been able to supply that. And that's why we've seen that, is especially when, we had the supply chain problems that we had a year ago.
Okay, so with these supply chain issues, could them being resolved contribute to a deflationary environment, or is it just going to be lack of demand that takes prices down?
No, actually, you're spot on. I think it's both. I think it'll be a combination of both, because you'll actually see that what happens when you have a demand, we will, as suppliers, make sure that you get the supply. So they will start to say, okay, we need everything. Let's start producing stuff. And then you'll see the demand actually will start, will probably not be as strong as everybody expected, because it was kind of a wait and then we go by, and then you get the spike, and now the supply is back, and you see the stimulus is also wearing out. So you can get a kind of a double whammy on that due to that.
Okay.
So, but we did see the inflation move up, and that is something probably that can tie the hands of the Fed, and that's why I'm thinking that. It may not be when I'm talking deflation, people are saying, yeah, but you're not going to see a 2-3 years deflation. No, I'm not talking about that. I'm talking about a liquid deflationary event where you said everything will be sold off, even the kitchen sink, to get cash. And if you think about it right now, that I don't think the Fed has, their hands are at least more tied up now when employment is unemployment, of course, is back down again. Unemployment is back down again. We got rising inflation, or higher inflation. We got soaring stock market. We got bottlenecks in the economy, and we got real estate prices through the roof. So if something starts to slow here, and we have the Fed started to talk about taper, then there will be, okay, so now we need to print more money immediately. We restart QE immediately. I think there is enough room in that, kind of, tie with their hands kind of tied, at least for the short time frame, that you can see this short period of time, which again, if we go back to 2020, February and March, where we had 2 months, as you said, 6 weeks, where we've dropped 30 some percent, 33% or something, we could easily see the same thing again, easily. And I think that's what's in the card. That's why I'm not predicting something long term, but the the size of this, because of the bubble that we see, and I think that's where the equity bubble will finally come crashing down. I don't even want to discuss if there's an equity bubble. I think that goes without saying. But when that happens, also whether it's because of a voluntary or involuntary, whether it's the market's going to do it or because the Fed actually says, okay, we got to put a limit to this. Let's try. Then something is going to bring it down. So that's what I think is happening. And
so how long do you think it will last? It'll be longer than 6 weeks, don't you think? This time more dragged out, 6 months to a year to get everyone to puke everything they own?
I think I'm watching charts for that as well, and it's often when you look at charts, you get the similar kind of decline. When you see a decline, you got the similar kind of slope on rallies as well. And if you take the similar kind of decline on, this is a commodity, so this GSCI commodity index.
Yes.
And just tells us something about, okay, so we had an inflation bounce, which I call it. We actually had the first deflationary bust back here, as I said, in 2020.
Right.
And now I think the second deflationary bust is going to develop. And I think it's not going to last much longer necessarily. It can take, a few months, or 3 months, 4 months, because if we follow this kind of thinking here, well, it can be we can start this month, next month, and then it'll, feel it for real into the start of the new year. And then we can see a large bottom. But I think the difference will be this time that you will probably see, like we did in 2008, where we did see commodities and gold miners and the like drop severely from in the early phases until this great solution about QE came along in October 2008.
Yeah.
But then you still saw stock market decline until March of 2009. So you had a period where the real economy or the stock market really was not feeling now that the solution is here. Right. And I think we could have a similar kind of scenario this time around. So that means that we could have commodities and
commodities bottom before equities.
Exactly.
Okay.
And that's why I think also we probably could see that you will have this is my theory. This is based on a lot of charts and a lot of analysis. But the deflationary phase, like what we saw here, maybe a little longer, a little more extended, a little more severely than last time, because this time around the Fed will not be able to act immediately because we have higher inflation rates at this point, a little more tied up. They'll have to wait, and then they will do something at some point, of course. And that's where I think, based on the long-term charts I see, we are that close to a significant secular low in inflation, which I compare to 1982, 1981, where Fulcrum Oldman brought about the whole deflationary regime that we've had ever since.
Right. So, August 82 was the beginning of this prolific bull market in stocks. I remember because I was short when it turned. I was short IBM, Henrik. Anyway, and I remember when it turned about at 760, August 1982. All right.
I was 7 years old, so I don't remember that well.
Oh, don't rub it in, you punk. Okay. All right.
So, but I think that will be the start of a new, what I call inflationary regime. So everything works, and in the long-term basis on a pumping in, pumping up, and you get this inflationary cycle on a longer-term basis. And I think this is going to be the bottom. They're going to find out a way to finally decapitate deflationary forces, like what Volcker did back with the inflationary forces. And this time around, I think the double effect of the fiscal stimulus compared with the monetary stimulus, and I think the fiscal part now will be what really brings about the inflation and the new regime. So I think we're going to see that now, because we need to see the bubble come bursting down, and that will not be an inflationary event. That will by itself be deflationary. Honestly, I can't see how that can be inflationary. But this is the two-phase crisis that I think is coming. So first, the deflationary part, short, sharp, illiquid, everything is sold off. Then this final bottom, this in inflation and in a lot of commodities, and in all commodities and in miners and the like. And then you see the new inflationary regime, but getting born in what I call in stagflation, getting born in stagflation, because we'll see that the real economy will be struggling for a few years before it's really we solve some of the structural issues that we see. So we could have that inflation will be coming up due to the kind of the effects that we see right now, and due to the fact that they just push everything into it. But the economy will struggle because it's not running as smooth as it's supposed to, and that's why it can be a bumpy start, which will be a stagflationary period. So two steps crisis, kind of crisis could be coming as I see it.
Okay.
And that will play into what I think in the stock market. I think, you know, this extreme bubble, this sugar high is going to come down. I saw some just, you know, this is just, you know, I can put charts in, arrows in everywhere. But if you look at the what we saw in the Nikkei and kind of compared that back in the 80s, 1980s, and we saw the decline we saw after that. Well, you know, we could easily see a decline like that. And of course, we saw the Wall Street crash of 1929. And with the kind of, you know, valuation levels that we got right now, which are through the roof, which are higher than have ever been, well, then why is it so inconceivable that something big should come the other way? I mean, everybody can understand and kind of appreciate. We got 100% rally over the last year, but could the prices come down 60%? No way. You must be out of your mind. I think that's quite obvious that you're going to see something significant to the other side. Am I forever bearish? No way. I will definitely make sure to get right. To get in the right assets when the crisis unfolds, and that's where I think the combination of that deflation, stagflation kind of takeoff is something that's going to trigger a lot of people.
Okay. Yeah, you have to get them to liquidate out all their stuff, and they won't come back in, will they?
Exactly. And if you get liquidated, then it's more difficult to get in at the right point. So it's about getting you prepared for that. If we believe that's going to happen, that's what I do. So where to hide is a good question, of course, and that's as I see it for now. It's you know, step one, deflation, long dollar versus everything, and I think the Dixie is going higher. It's going to 110, 11, 110, 111, 117 even. And I think everybody is mistaken by this, that we have seen a decline over the last few months, year. We've had a sideways consolidation, as I call it here, which is actually a running flat as I see it. And that is something that should take off quite severely and soon. And if you look to this chart here with the real 5 years swap spread, it seems like the euro could be crashing down versus the dollar, which would actually, you know, point to this picture exactly, and would be part of a deflationary regime. A strong dollar like that would definitely cause some trouble and some headwinds. So, so this is the scenario in terms of this is where to hide in the short term time frame and in the deflationary period. And of course, when we get that then to the stagflationary part of it, well, miners, gold, Bitcoin, everybody thinks I'm just Bitcoin bearish forever. I'm not. And then energy-related companies, commodity-related companies, and here are some. This is GDX. I think there will be another low on GDX before it takes up for real. Gold, I still stand by my call. You know, everybody said back then we should have been at 5,000 now. Also, I said we would not. I said we should have been at 1,000 now. We are not. None of the places, but I still think we're going to see that decline due to the structures. Bitcoin, I think the same thing. When the dollar starts to rally really hard, we are going to see Bitcoin coming down hard also. And energy-related companies, this is Cameco, so uranium. Well, another low also, but a fantastic opportunity to buy. And that's the focus. And that's why it's so important here. Because
and that's a green energy play too. I know some people that, participated in this recent rally in uranium. So, what you're presenting, from your lips to, whose ears, is going to give people a chance to buy assets at fire sale where you want to back up the truck after this, right, Henrik?
Exactly that, and I think that is what we could we will see. I mean, I cannot see how we can get to a point where we just keep taking off when everything else in commodities and so on seems to tell us actually we're declining. We saw lumber, we saw that take off. Everybody was so excited and said, well, this tells us that inflation is here, and now it's not. And we actually rightly called that one and said, well, we think it's going to come crashing down. It's down like 60-70% now. So
and even grains, which the Fed can't control, they can't print corn, right? So anyway, even the grains are under pressure now.
Yeah. So that is what I think is going to come out, but it's going to be a fantastic moment if you're ready for this, and that's why I've been so patient. Of course, we do not just sit around and wait for this. There are a lot of interesting things. I'm actually long gold just right now, and I think there's going to be a significant high soon within a few days. But it's okay. Of course on the bigger picture here and on what could be really. Sounds maybe a little, corny to say life-changing, but actually I do think it can be, because you can get it at fire sales prices. You will be able to, as you said, back up the truck and do really well for a long time.
And, maybe with a little bit of spec capital, you try and take advantage of the washout.
Sure. Yeah, exactly.
Yeah, it improves your cash position for the bottom.
Yeah,
so
exactly.
Is that where is that the last slide as far as markets are concerned, Henrik?
Well, actually, yeah. So short term, I said I'm short,
okay.
Long gold, and I expect
okay.
there is going to be a nice high here. And that's just to say that I'm not just just sitting and waiting around for that, of course.
Right.
But it's only to short it soon also gold, because I think it'll be coming down. And as I said here, I have been and still am patient. That's me still, growing older or getting older while I wait. But it's about, as you said, getting prepared, getting cash long, and then act aggressively when the time is right. And I think sincerely believe that there is an opportunity of a lifetime coming here, and that's what I kind of try to show here in the charts.
Well, you have a great following, and people with maverick type of thinking that believe that gravity still can exist for another 6 months or a year. And how would people get a hold of you, stay in touch with you? I know you have a newsletter now, and I think you've also developed some type of trading system. Do you want to talk about that?
Yeah, sure. So we have the Zeberg report, and we are a small team behind that. We publish a video or live show we have every week, and we got some of the subscribers there can then be part of that, and also have live questions on the show, and we will they will also request for charts, and we'll then be telling the story. Where do we see we are in this whole story that I just told here? And then we will, so that's this part of it, and you can find that on the zebergreport.com. And then we have, of course, also we have a more short-term trading offer here, which is quite new, which is called Vera. And we have a focus on crypto, forex, and commodities at the point.
Is it an acronym for something, Vera?
Yes, it is.
For what?
Come on, man! I can't remember right here.
Very excellent.
Variable empirical real-time alerts. So
okay. Yeah. Okay. Nice to meet you, Vera.
Yeah,
what's your phone number?
Yeah, what's your phone number?
All right.
But he's doing quite well. There's nothing to do with Elliott waves or anything like that. That's a system.
And you have a free trial for people to check out. I see.
We do have a free trial also on forex right now. Yes, and we did kind of, and we'll be following up on these performance results, and it shows on the long-term basis. It shows kind of nice results when we have been backtracking it, but we want to have them for real. So that it's after the system actually has been started running, and that the last 2 weeks the results are down there. So that's good, and we will expect much more of that also going ahead.
Well, my trading warrior brother, another great presentation, and I thank you so much. I really want people to think about the markets, not just from one point of view, but to consider various point of views, and never do anything blindly. Never take people's trades or advice blindly. See if it lines up with your work. But there isn't hardly any of this out there anymore. It's been the baton death march for bears, and I think bears are due to go into hibernation in the winter. So there's still, they still have time to do some damage with the dollar wrecking ball by December 21st, when winter begins. So I really appreciate you being here and enlightening us and showing us the possibility of gravity, Henrik.
Thank you very much, Dale, for having me on. It was a pleasure to be here.
It was a great interview, my friend. So my trading warrior brother, Henrik Zeberg, check him out on Twitter at Henrik Zeberg and zebergreport.com. Good hunting, everyone. Good luck in front of the NFP tomorrow. And that's a wrap. Hope that this opened your mind to the other side of the market, because markets don't always only go up. Thank you, Henrik.
Thank you.
Appreciate it.
Thanks.
Adios, everyone. Good luck tomorrow. See you, Henrik.
See you. Bye.